Welcome to Coleman Report Live. I'm Bob Coleman. We're talking Main Street and the small business lenders who help it grow. Lance Sexton is in the house. Good to see you, Lance. You're looking good. Delaney, welcome. And Anna Riggs on becoming our hotel expert. Anna, so you and Delaney are giving us excuses about ice storms and snowstorms and snow days, but we'll ignore that. Well, you're here, so welcome. Number one, we're going to talk a lot today, but we're going to release our compensation survey. And Lance, this is sort of up your alley. Loan underwriters, do they get paid more or not?
And I'll let everybody answer, but I'll tell you what I know is the answer.
You notice we just gave you two options. We didn't give you the I don't know. Split?
Yeah.
Lance, what's your opinion?
So an SBA underwriter typically is a 20% premium above a conventional underwriter. Thus, Bob, I shared with you, I teach at a small university here. They're getting ready to develop a minor in SBA lending with me as a faculty member. And one of the things we're going to do is train new underwriters for banks to hire. So
I love that idea. And I've already committed. We'll take a couple of them on as interns. So
yeah, and you'll get a underwriter who can tell you what SBA stands for, who can develop a compliant credit memorandum and other things, but very excited about that. But the typical pay is higher.
Yeah, I don't know if I'm with Lance at 20%. I'm not going to argue too much, but it's definitely in the 10 to 15% range.
Yeah, if we've had some experience, we've had to hire an underwriter or two over the past 12 months, and it is at least 10% higher, if not up to 20.
We're releasing it today. Fill it out. This is a question we just took from our underwriters. These are the things we're asking. Lance, we're adding one new nuance this year. We're asking everyone the question, if you could change one thing about SBA lending, it would be.
Oh, I love that.
I'm looking forward to those responses. Here's our promise. Fill it out anonymously. Give us a Hotmail email. We don't care. We don't even look at them anyway. So all we do with those emails is we send you a free copy of that and we delete them. We don't put them in our database. We just get rid of them. Go ahead, Lance.
So Bob, being a numbers guy, I was sitting there thinking to myself, we're talking about salaries, and then I saw those 4 categories down there, and I'm like, if one of our underwriters is making more than $1 million a year, I want to know what bank you're working at, and Lance has a resume ready.
And you have your resume. No, Lance, those are dollar amounts.
Yes.
So we're trying to do some benchmarking. Anyway, fill that out. That's available now. I believe Joseph has a link on that, and the survey is open until March 15th, so you got plenty of time on that. Delaney, our fraudsters actually, the Department of Justice has been busy at work. This one, let's see, the cars are impressive. A Bentley, a Lamborghini, and a Ferrari. Am I correct?
Yes, you are correct.
And they got the money back. And this is my neighbor, Irvine, couple up the road here. What did Mr. Kadiri do?
Mr. Mustafa Kadiri was sentenced after obtaining more than $5 million, which makes sense why he purchased 3 luxury cars in this case. So he was submitting applications for sham businesses, none of which were actually in business at the time of application. He was inflating information about the number of employees, their wages, altering bank account records. He also used somebody else's name and social security number to apply for one of the PPP loans. So it didn't give us more. Sorry, what were you saying?
You're fine. Go.
I was going to say they didn't give us more information about specifically where he went on vacation and what kind of payments he made, but they did say he went on lavish vacations in addition.
And they still recouped some money. Go ahead, Lance.
Delaney, this is an example of what we talked about a few weeks ago, synthetic fraud, a new term? I think it is.
Yeah. And Delaney, we need to highlight, we sort of glossed over it last week, but I want to highlight the fraudster we had on where he ended up giving all the money away. That's the first one we've seen. He gave it to his relatives to pay off their houses. And I'm sort of curious, did those people lose their houses? So I want to... we'll follow. Just make a note. Let's follow up on that one. But I was thinking about that. That's the first good do-gooder we have, Lance, and
It would be interesting to
It-
see
it-
if they were, it would be interesting, Bob, to see if they were actually able to go after those houses because the houses would have a deed of trust in a different name. So it'll be interesting to see how that
Yeah,
turns
I
out.
was
Bob,
thinking about it. Or maybe
Bob,
just they refiled that deed of trust. I don't know. Go ahead,
I'm
Lance.
sorry, Bob. The only way I ever got to drive a luxury car like these PPP fraudsters, back in 1984, I was working in FDIC bank closure and I was in charge of special assets. And the bank we closed had a Jaguar. And for a brief period of time, I got to drive a Jaguar, like 24 hours, prior to selling said Jaguar. So I haven't gotten to experience these excellent luxury cars we talk about.
See, I don't
Except that
want
one
to drive
time.
one of those. I want, give me the Earth Mover.
Yeah.
Big construction, yellow.
Well, and I think one of the things that's funny, Bob, and you and I remember these days, there was a day when banks might have luxury cars as bank cars.
Oh, yeah, I remember that
Yeah.
very well.
There were days.
More.
It went from Bob, in my early years working for FDIC on bank closures, luxury cars, to Delaney will remember this. I worked for a small community bank and I had a car. It was a Ford 500. And now I don't think there are very many bank cars at all. So
Yeah, very good. What else you got, Delaney?
So the second story, Mr. Raymond White. The good thing is this is a little bit different than a lot of the cases we've been covering, just to mix it up some. The fraud is not good, though. Mr. Raymond White, he was submitting fraudulent documents and false information about himself and his company in order to obtain an almost $5 million contract to build a training facility on an Air Force base. In order to get this contract, he also had to get a bond guarantee from the SBA. So he was submitting other people's signatures, social security numbers. He even made a claim that he built the big soccer stadium for Brazil a couple years back, but he was actually in prison for a previous fraud case. So he got caught up in all of this and will be probably serving a pretty hefty sentence.
Delaney, it is football. It's not a soccer stadium.
Football. Yeah.
You have to pronounce recidivism. You have it up there.
Wait, I'm sorry.
You're fine. Let's one more, and then we got Anna waiting in the wings.
So this is a story I've talked about a few times previously. This is the very end of it from what it seems. The final participant in one of these bigger fraud schemes was finally sentenced. Amos Mundindi was sentenced to 42 months for his participation in a scheme that they applied for 30 million and ended up causing about 15 million in losses.
wow.
So beyond just submitting their own applications, they would also actually get business owners in on this operation and would submit fraudulent PPP loans and false information for them as well. So,
Well, yeah,
it seems
42
like they
months.
all got justice.
That's a lower sentence on the scale for that large of a fraud. But
Yeah.
I believe the other people got much bigger sentences, and I think they make up for it in restitution. Most of them, I believe the lowest is about 2 million, and one of them was about 12 million.
yeah.
So it seems
Well,
like
again,
money
go
back.
ahead, Lance.
One of the things I see, Bob and Delaney and Anna, is it seems the sentences somewhat are dependent on how well they recover. In the cases where they pay back a majority or all of the loan that they got, shorter sentences. In cases where they spend it on lavish vacations and other things that they can't come back and recover from, those sentences are much larger. It also depends on the complexity of the fraud, and how many cases. Like, this guy had multiple applications. Those sentences tend to be longer as well.
Well, and they're doing a very good job in negotiating these guilty pleas because they're saying, hey, if you want to go to trial, you go to trial. But here's your signature, and here's the false documents. Oh, and you're facing up to 30 years in jail or prison, state prison or federal prison, or not a place you want to be.
No.
Anna, tell us what's going on in the hotel industry, and what are you learning?
Yeah, so today I'm just going to talk a little bit about the state of the travel industry, which directly affects the hotel industry. It's been slowly recovering since the height of the pandemic, and the recovery of the travel industry is crucial for the global economy as it supports various industries, as mentioned, hospitality, but also transportation and tourism. And it'll take time to fully recover, but there's been a recent uptick in domestic travel, and the steady return of international travel is a positive sign for the industry's future. And on average, travel managers for the U.S. estimate that their domestic bookings are at 67% of pre-pandemic level, which is really good. And Europe is slightly behind here at 63%. But what's interesting is while the U.S. is leading in domestic travel, Europe is leading in international travel. So international business is continuing to slowly gain ground. In early 2023, international trips were making a big comeback, and the Europe's recovery is currently at 60% of pre-pandemic levels, and I believe the US's is around 50%. So this is interesting that domestic recovery is recovering quicker in the US. And this increase in international and domestic travel is a positive sign for lenders, very positive for lenders looking to finance hotels. Lenders will need to evaluate the financial health, of course, before making decisions, but the industry is only seeming to get stronger.
And Anna, help me out. We did a poll last time you were on, and we asked everyone on the line, how much is your travel different today than it was during the pandemic? And the results were, if you recall?
Yeah, travel today is much popular than it was during the pandemic. The poll results clearly showed that.
And pre-pandemic as well, travel is up. So that was,
yeah.
Well, this is great news, Anna, because the hotel lending segment of SBA lending is kind of it's a double whammy. Their revenue, the number of rooms booked, is starting to tick up, which is a good thing. On the other side, the Fed keeps increasing the interest rates. Hotel loans are larger loans, and their cash flow needed for debt service coverage continues to tick up. So we need this to continue, this trend to continue, so we have healthy hotels going in the future.
And as an aside, Anna, and you and I haven't talked about this, but the state of California introduced legislation, I think Monday or Tuesday, that said they are going to demand that hotels do away with all the hidden fees and all the hidden fees, and that they will extend that to car rentals and other places, and that if they're advertising the 189 fee, they don't want you to add on these resort fees and valet parking, all this other stuff. My question on that, I don't have an answer, is how that affects lenders, because we have a bunch of fees that we add on as well. So that's interesting, and the history on that is it will pass in some form, so that'll be interesting if that affects travel at all. But it certainly is going to be better for disclosing, as I know that's probably one of the number one pain points, Lance, is when you're traveling, all of a sudden you get $100 a night additional fees that you weren't planning on.
Yeah, they give you a $300 rate, and then you see your bill and it's like $389. So
we all have those stories. Joseph, we have a question for Lance. Bring it up. Thank you, Anna. That was very good. And Delaney, thank you. I don't mean to. Lance, I'll deal with you later.
You can, on an existing business that owns commercial real estate, do 100% financing subject to. So an existing business has a net worth. And let's say they're acquiring a new piece of real estate. I did one for a small business in Northwest Arkansas where they were a 20-year-old business. They had a balance sheet that, they had $600,000 or $700,000, and I'm just remembering, $600,000 or $700,000 in assets and about $400,000 in net worth. They wanted to buy a new building for $250,000. when we did a pro forma balance sheet and stuck the hotel property in there, it still showed a more than adequate net worth or equity position. But the SOP basically states as long as the blended pro forma balance sheet shows a 10% or more equity position, you can do 100% financing for an existing business on a piece of commercial real estate.
And you can do more. I mean, we're not capped at 100%, correct, Lance?
So yes, there's several related questions here. So 100% financing, life insurance for any collateral shortfall. Anytime there is a collateral shortfall on an SBA loan, one of the best things you can do, and the SBA Inspector General will tag you for this if you don't do it. If you have and of course SBA loans, it states they don't have to be fully secured, that you take all available collateral. And if it's undersecured, one of the best ways you show SBA that you're taking all available collateral is that you get a piece of life insurance on the guarantors. So, and that life insurance can be split up. Some institutions will make the guarantors get life insurance for the full amount of the loan. Some will make them get life insurance for the shortfall of the discounted collateral value. And they can split it up between guarantors.
What would Lance do?
Lance is going to get the full loan amount. Especially, here's the thing, Bob, if you're my age and you're getting an SBA loan, they're saying, hey, Lance, you need $5 million in life insurance. Well, it's really expensive for me to buy $5 million in life insurance. If you're Delaney and Anna's age and you're starting a small business and getting an SBA loan, getting a $5 million life insurance policy is maybe $250, $300 a month. So, a lot of it, I'm going to get as much life insurance as I can get. Having been in servicing and liquidation, I've seen a couple of SBA loans paid off by key person life insurance policies. So, yes, if there's a collateral shortfall, please get some life insurance when you're underwriting and closing your SBA loan.
And remember, the secret for bullet point 3, if no other collateral is available, can we still go up to 100% of value? The answer is yes, because we're cash flow lenders. As long as the cash flow analysis supports the loan, collateral is secondary. And as long as you have all available collateral and you have the cash flow, you can go ahead and do that transaction. But I agree with you. Then the reviewers are going to say, fine, your cash flow, but where's life insurance? Now, if they were unable to afford the life insurance, then you simply put a memo in the file. It's too expensive, and that will be accepted. I've never heard of a lender being criticized for that. Have you, Lance?
No. If life insurance is going to cause an economic hardship on the individual's business, then it can be waived. And when I was deputy director at SBA, back when SBA approved more of the servicing actions, that was a very common request from participant lenders, is waiving the life insurance because it was too expensive.
Real quick, I'm sorry.
But
go ahead.
One final comment, Bob. You can do 100% of CRE when the blended balance sheet shows an appropriate 10% or higher net worth, but not on a startup. You don't have an existing net worth there.
One last item, that Lance is doing a new webinar March 15th on Patriot Express. And Lance, you're going to be doing it from everything. We want to do a full review, not only underwriting, but closing it as well as servicing it and liquidating it, because there are nuances in all of that. Yeah. And we haven't offered that before, and this is new to the industry, but I thought with the fee waivers and the changes that are coming, that it would be a nice review in terms of bundling everything together. Lance, I think that'll be a fun project and a fun presentation for everyone.
Absolutely. As I dig into it, most of the underwriting and closing requirements are similar, but what's important is knowing what's different. And that's what we're going to try to play.
And the reason why this also came up is SBA is requiring more certification on eligibility. So we're going to make sure that everyone is doing it correctly. Delaney, Lance, Anna, very nice. Thank you very much. Everyone be safe, and thank you for joining us today for Coleman Report Live and for supporting America's Main Street, one entrepreneur at a time.
Have a great weekend.
Thank you for joining us today for today's episode. If you like today's content, hit that subscribe button to subscribe to our channel and click that bell icon to get notified about our latest videos. Thank you again for joining us today and for supporting America's Main Street, one entrepreneur at a time. Catch you next time.